Welcome back to How to Invest for Yourself. I'm Jason, and today we're going to be talking about what velocity banking is and how does it work. So this is going to be a fairly long video. I know it's going to be very wordy. Not much flash going on here. This is mostly built for those that are driving down the road and or listening to something and not really watching something. So if you have time and you are sitting around and you're watching this from your computer or from your TV in your living room, wherever you are listening to this or watching this, do grab yourself your favorite beverage, whether it's a coffee or a drink of water, or maybe it's a Coke, who knows. Grab yourself something, grab yourself a notepad and a pen or a pencil, and let's get to this. So the first thing is velocity banking. It is not a bank. It is a process. It's a method. It is a theory. It is just a reallocation of how your money is sent in your account and how it is used. It is a method of cash flow, a flowing of currency. And the word of currency is that it has a current, that it flows in one way and flows out the other. So currency flow. All right. So the methods used to help what is it, right? The method is used to help people pay off car loans, student loans, credit cards, you name it, as fast as possible, right? This flies in the face of the Dave Ramsey theory. And it could be maybe just an old theory, but most everybody knows everything that we run on nowadays in our society is credit based, and cash is not king. Having credit or having the funds that you need to do or lock in a deal nowadays is the best method. So you could have a ton of loans, a ton of lines of credit, and a ton amount of credit cards. As long as you owe nothing or you have a minimal amount of debt on it, you should be fine, right? So back to step 3. So step 3, or question 3 here, or statement 3. I stand corrected on everything here. So number 3, what velocity banking is not. What is it not? It is not a means to get rich. This is a means to pay off debt. This is not a Dave Ramsey supported theory. Dave Ramsey hates debt. He hates credit cards. He hates any kind of loans whatsoever. And if you're going to do any kind of debt, he's already telling you to look for the zero interest or look for something that is a investment, not to go into debt. So his first rule would already be to not go into debt whatsoever. No debts, no loans, nothing like that, right? And I would agree with that. So what you would want to do then is just make sure that you pay attention to how can this be used, right? What is it, right? So let me go back to what I was saying. What it's not is it's not a bank. We mentioned that before. It's not a means of getting rich. It's not a Dave Ramsey supported theory. Okay. So how can we use this? How can we use velocity banking? What are the rules if we decide we're going to use this method over the Dave Ramsey method or any other method that you can come up with paying off debts, right? So what we're going to look at is ourselves. You got to know yourself. You got to know your spending habits. You got to know what your vices are. What is your hobbies? What are you into? You know, are you a person who's into collecting knickknacks or trinkets or video games or clothes or shoes or cars or computers or video games? What is your habits, your spending habits? Not saying that having any kind of like hobbies and things like that are bad, but sometimes they can get out of control where you start using your credit card or getting loans to buy those hobbies, and they just dig yourself into a deeper debt, right? What is your personal financial goals in your life, right? Do you even know what you want to do in the future? Are you one of those people that say, oh, I'll plan it down the road when I graduate from college, or I'll plan it down the road when I get that promotion, or I'll plan it down the road and figure it all out whenever I'm 50 years old or 60 years old? Do you even know or understand that time is against you, and that time is very precious, and that every dollar that comes into you needs to be working for you all the time, 24/7, 365 days a year. That money will not work for you if you don't assign a goal for that money. You have to assign that money to something, to either getting out of debt or investing in something that's going to pay you back. I'm a very firm believer in buying stocks, and it's not just stocks, but dividend paying stocks that are going to pay me back for owning them. I don't believe in just buying a stock and then it do nothing and just wait for it to appreciate. I would rather get paid dividends so that I can grow the amount of stocks that I have, reinvest it using drip, and just keep reinvesting and reinvesting and reinvesting until that account grows significantly enough that I can retire based off just my stocks. But that's not the only method. I never put all my eggs in one basket. So I'll talk about other things in the future, about your goals and how you would want to set up yourself for your life in the future. Do you want to be working 9 to 5 when you're 60 something years old? Do you want to keep grinding it out and continuously trying to pursue or compete against people who are younger than you when you're like 65, 70 years old, still trying to make your ends meet, and your skills become obsolete at that age? That means you have to go back to school, you have to get more education, which means more debt. All right, well, let's not look at those things. Let's start looking at that stuff now. What can we do with the dollar bills we have now? All right, what will drive you in life? Like, to want to see this through to the end. Like, if you use velocity banking, what is it in your life that is going to drive you to want to see it through to the end? Is it that you're getting sick and tired of the grind of where you're working, and that you want to make a change in your life? You're tired of paying the debts that you have and seeing your money just go from one hand to the other. It comes in and goes out extremely fast, and you're down to like $20 in your account or less, and you're constantly living off of credit cards. Maybe that's what drives you to want to see this process through to the end. So you have to change your mindset. You have to change your mentality. Okay? Having self-control over your spending and your debts is very crucial for the success or the downfall of you pursuing velocity banking. So you have to understand you need to control and ask yourself every time you look at something that you would like to have or that you want to have, do I really need this item? So the key word here is need versus want. Look at something that you're buying. Say it's a pair of shoes, or it's another a new iPad that came out, or a new Apple phone. Do you really want it, or do you need it? And what I mean by you needing it is like you're holding the phone that you have in your hand now. It's already been like smashed to bits and it's falling apart and the battery dies and it could catch on fire at any moment. At that level, then I would say, okay, well, you need a new iPhone, but do you really need it? So let's say your phone that you got now is perfectly fine. There's nothing wrong with it, but you like the new shiny thing that just came out, and you're like, okay, well, I'm going to go and spend $1,500 on this phone because I gotta have it. No, you don't gotta have it. You just want to have it, but it doesn't mean you need it. Okay, so we got to get that mindset down. Start asking ourselves questions when we buy things, even the smallest things. Do I need this or do I want this? And if you want this, why do you want it? Right? You kind of start analyzing your purchases. You don't have to go too deep into it. Make it a 5-second thought. Be like, okay, I like this new mouse monitor and keyboard for my computer, but do I really want it or do I really need it? So let me think about what I got at home. My monitor, mouse, my monitor, my mouse, and my keyboard works just fine at home. I don't need it. Okay, so then you just have that little quick conversation with yourself. Or maybe you're a person who buys a ton of shoes. You go, I'm gonna go to the shoe store. I'm gonna go buy some shoes. And you look at the shoes. You're like, man, I like that pair and that pair and that pair. And you gotta start thinking to yourself, well, do I really want those shoes or do I need shoes? Well, how many shoes do I have already? Well, I got like 50 pairs of shoes at home. I don't need to add 3 more pairs of shoes. Can I wear all 50 pairs of shoes I have now at my house? all at the same time? No, you can't. Well, what? Well, then you don't start justifying your purchases and be like, well, I need a black pair of these shoes and a white pair of these shoes and a blue pair of these shoes to go with this outfit and that outfit and this outfit. Just keep it simple. Like, reduce the amount of stuff you have right now and cut back on how much you're spending and wasting money on. So self-control over how you spend and control your debts. This is the only way it's going to work. So if you have bad habits of spending, this is not going to work for you. Keep yourself honest and don't leave any stone unturned when you're looking at your numbers. Look at all the subscriptions that you have. Look at the loans that are tied like an Apple credit card, for example. If you go and buy an iPhone, they could do the zero interest for 12 months or 24 months, and that's being charged to your credit card. Be honest with that amount that you owe, how much your payments are being charged against your credit card, what's the interest rate on your credit card, because even though they may be charging you zero interest on that phone, your credit card is still charging you interest on the amount that's on that credit card. So if you're adding $24 or $48 a month to your credit card every single month and you're not paying in full your Apple credit card every single month, you're being charged interest. Whether they say you're being charged no interest or not, you're still being charged interest on that cell phone. So you got to be paying attention to all these little hidden things and pay attention to the words of deferred interest. Best Buy is notorious for this. They'll say, oh, you can buy the washer, you can buy the dryer, you can buy the TV, you can buy the computer, you can buy whatever you want, and we'll defer for a certain amount of months your interest. We'll give you zero interest for 21 months or 24 months or whatever the number is nowadays. Could be anything, depends on the dollar amount you spend. But what you're not understanding is deferred means it is not being charged interest at that moment. You're being deferred out until the end of that time. So if you don't pay off all that money that you borrowed within that time frame they tell you to, all that interest has been accumulating over time. And then on that last day of that deferred payment, you're going to get hit with a huge chunk of interest right there onto your payments. All right? You need to know what money is coming in and know exactly what money is going out. So if you're a person that gets paid salary, it should be fairly easy to know when you get paid. You should also know that if you get bonuses or you don't get bonuses, that kind of information can be critical on helping you pay off your debts even faster. Don't count the money in your budget as a bonus, but just know that it's coming so that you can pay off things. Don't go overspending, saying, oh, I'll be fine. In Christmas time, I'm going to get a bonus, so that'll pay off this spending. Don't justify your spending now for future gains. What I'm saying by that is, just like I just said, don't go and say, I'm going to spend like $1,000 on Christmas presents because I know I'm going to get a $1,000 bonus. That'll help me pay off my credit card whenever I get my bonus. Well, what happens if it comes to that time of the year and they go, we're sorry, but due to constraints and due to the economy, we've cut all bonuses this year? Then what are you going to be? What's going to happen to you? You're going to end up being stuck with that $1,000 debt, and you're going to be paying interest on that debt, most likely. Okay, so don't spend money you don't have, right? Okay, know what your due dates are for all your bills, for all your expenses, all your debts, all your loans. You need to know when things are due and make sure that you pay your bills on time. Do not be late. Okay, make sure that you know what your interest rates are, know what your fees are on those debts, right? If the IRS goes, we're going to charge you 50% interest, you need to know it. You need to know exactly what that interest is. Is it charged compound daily? Is it 50% per month? Is it 50% per year? What is it that they're charging? What are the fees? Oh, you didn't make your payments on time, so we're going to tack on 10% penalty fee, and we're going to charge you 50% interest until you pay us in full. So this kind of information is very important to you. But let's also go the other side. Let's say you have a credit card that's zero interest. Like, man, I'd like to transfer all this other debt into one credit card to simplify my bills. But do you know how much interest they'll charge you or any fees that they will charge you to do that transaction? To say, hey, I got $10,000 free on this credit card. I'm going to consolidate all these cards. They may charge you 5% for each transaction that you transfer into that zero interest credit card. So you got to know what your fees are. And you also need to know it for velocity banking purposes. How much are your cash advance fees? How much are your transfer fees? And also, what kind of interest are they charging? Are you charging you based on the daily compound interest, daily compounded simple interest, or is it just a monthly average simple interest? Right, those are kind of crucial, just a little bit on the debt tool, at least on how you would calculate your interest. All right, you just because that you pay off a debt like your credit card doesn't give you the green light to go out and get back into debt. Doesn't say, hey, oh, well, I paid off this credit card, I got $15,000, I'm gonna go buy, some clothes, or I'm gonna go buy some shoes that I've been holding off for. Don't even do that. Just, if you're already on the path of getting out of debt, keep yourself out of debt. And then once all your debts are all paid off, then we will restructure how we pay our debts and how we look at our debts for the future, so that we don't get back into debt, but we actually use those credit cards and those type of loans to our benefit. For example, Costco, for example, gives you a 4%, 3%, 2%, 1% on different types of purchases like gas, groceries, shopping at Costco, things like that, and everything else. So if you can get to where that card is zero, you owe nothing, no balance on that card, and you go and you buy gas. As soon as you bought gas, make it a plan to either that night or the next day pay off that credit card. Get into a habit of using the card and paying off the card as soon as you put a purchase on it. So you know exactly how much money is in your account, your checking account, sitting there ready to go. And you'll be like, okay, I know that this week's budget is I'm gonna spend $40 in gas. Then you'll go and swipe the card, get the 4% cash back, pay off the card, and then you pocket that 4% cash. For Costco, it's not instantaneous. It's more of at the end of the year, you will get your accumulated 4%, 3%, 2% cash backs on those. And I like cash back cards. I'm not a points person, but let's say you are a points person and you have a flight one, right, for taking flights and things like that. So every time you make a purchase, you get points towards, like air miles and whatnot to flying for free and stuff like that. Maybe you're a person who likes to travel. Well, use your card, but pay it off. All right, so we'll get to that. But right now, Velocity Banking is going to be used for only getting out of debt at this point. Later on, we can use Velocity Banking for accelerating our investments and things like that. So we'll look at that later on. This video is not that. All right, so create goals for your money. Write them out, visualize your goals, and be realistic. Don't say, oh, I want to be a millionaire by the end of next year. That's not realistic. So if you're currently a $20,000 a year employee person working at McDonald's or Publix or Piggly Wiggly's, or just name the place, and you're just bagging groceries, you're like entry level. There's no way you're going to go from $20,000 a year to $1 million a year unless you're setting realistic goals to say, I'm going to start a business, I'm going to create this product, and everybody on the sun needs my product, so there's a potential that I could get to that. But otherwise, you need to visualize and keep yourself rooted in reality and say, hey, I know what I am, I know where I'm at, and I'm going to write out my goals. My financial goal is to pay off this credit card, to pay off this car, to pay off my house, to pay off my bills. That's the goals that I would set, and set timelines that are realistic. And most of the goals that I would set is something that can be calculated and can be measured, right? With numbers and with money, you can sit down, you can write it out, and you can calculate when things are due and when your payoffs are going to be met. Okay? Set short-term and long-term goals, things that you can reach within the first month, the things that you can reach within the next 2 months or 6 months or a year or further out. Maybe you can set it all the way out to 10 years, but just be very flexible. The further out that your goals are set, you need to be flexible on making adjustments to those goals just so that you can stay on path. Once you've accomplished your short-term goals, create new short-term goals for the next month or the next week or the next year. Do something like that. So short-term to me would be like a couple months, like 2 to 3 months out. That would be like a short-term goal to me. I would create goals. Once I meet those goals, create new goals for the next 3 months, and just keep rinsing and repeating those goals. And eventually, before you know it, you look back and you'll be like, man, I have accomplished so much within this time span. And it just has to be small goals. right? Pay yourself first and then your bills, right? That doesn't mean, oh, I did so great, I accomplished these goals, it's time to go get us some ice cream, or let me go buy this new cell phone because I deserve it, I worked hard for it. No, because that's bad debt. It's not helping you. So paying yourself first in this instance is using your velocity debt tool. You are paying your velocity debt tool first, so that way you can use your debt tool to pay your bills, to pay your expenses, to pay your mortgage, to pay whatever it is that you need to pay with your debt tool. Now, not everybody has the capability of using their debt tool to pay mortgage and to pay a car payment. Things that require cash or things that require a check or an automatic debit from your account. So that has to be considered also. All right. Gathering your numbers. So gather your numbers. You need to gather 2 to 6 months of your statements. So that could be your checking account, your savings account, your credit card, your personal loans, whatever you're using to spend money from or to pay debts from. You need to know what those are. And the reason why I say 2 to 6 months is because those things that are not static or locked in, like groceries, for example, or getting gas for your car, those things kind of fluctuate because the economy moves up and down. You want to kind of create an average. So like say, well, 1 month I barely drove anywhere because I was locked down due to something, being sick or whatever. And the next month I drove a lot. I went all over the country. And the next month I just did, my normal commute from home to work and work to home. So then you want to look at the average for all those. So that way you can take into account, maybe I don't travel for certain times and maybe I do travel for other times. And then I have my normal commute. So you can have an average of what your gas expenses are. And same thing with your groceries, right? You want to look at your groceries. Some months you'll spend $300, another month you'll spend $350, and another month you'll spend $150. It depends, right? Everything fluctuates, but you want to look at those numbers, write them down, and take an average, and then round up just a little bit to give yourself a little cushion just in case that month doesn't get accounted for. Let's say you wrote your budget for $400, but then you spent $500. Well, you didn't give yourself enough cushion on your budget to say, hey, in reality, this month I actually spent $500. It was Thanksgiving. I needed to buy a turkey. I needed to buy a fryer. I needed to get that oil to deep fry the turkey. I needed some gravy and everything else for that stuff. So you see what I'm saying is you kind of have to count in all those special events like birthday parties, if you make cakes or something like that. If you go out to eat, that fluctuates too, because not every restaurant charges the same amount. Maybe one day you go to Krispy Kreme's for donuts, and the next day you're like, oh, I'm going to go to Dunkin' Donuts and get some donuts. Or maybe you want to go out to eat and you go to McDonald's one day and you go to Burger King the next day, and then on the weekend you decide you want to go to the Ruth's Chris Steakhouse. You see what I'm saying? There's a fluctuation. There's a variable of money being spent there. So you got to know what your numbers are. So the best way to look at those numbers is to look at your 2 to 6 month statements, right? From your checking account, your savings account, your credit cards, and your personal loans. All right. Take a look at all sources of income coming into your checking account. Some people get disability. Some people get alimony, child support. They get pensions maybe, or you're collecting already some kind of disability or Social Security money. Anything that comes in, even if it's just dividends and interest payments coming into your account, you need to know what that money is, and is it significant enough to count in my budget. So if it's a significant amount, like sometimes, let's be real, some of the interest that you're getting on your checking and your savings account, even if it's 5%, isn't much if you only have $1,000 in your account. 5% isn't going to make a very huge difference in your financial goals or paying off your debt. It just isn't. Okay, so we don't need to count those kind of monies, but we do want to count like Social Security benefits, disability benefits, our pay if we're paid hourly, and then if we're paid weekly, or if we're paid salary, or maybe we're paid monthly. We kind of need to know what those numbers are. All right. So the next thing that we want to look at is know what our minimum payments are. What is our minimum payments on all of our credit cards? So even though you say, yeah, I'm paying more than my minimum, my credit card says that I only need to pay $100 a month, but I pay double, so I pay $200 a month. Okay, but we want to know what is your minimum payment on that card, because when we start the velocity banking method, we need to scrunch up as many of those whole dollars we can find so that we can start slamming out debt super fast. And if you're paying, oh, I'm paying an extra $100 on this card, and I'm paying an extra $200 on this card, and I'm paying an extra $50 on my student loans, and I'm paying another $1,000 on my mortgage. Well, we need to pull all that money back in and then just focus on one debt at a time. All right, that's what we need to do with velocity banking. Not focus on everything at once, just one thing at a time. So we need to make the minimum payments on everything we can make minimum payments on, and then focus our debt tool to tackle one debt at a time. The lowest hanging fruit, if you choose to do that, you can do the indexing method. I show that in my videos as well. Okay. We need to know what our due dates are, and we need to know what our closing dates are on all of our credits, like all of our loans and stuff like that. So loans, for the most part, we already know what the due date is, and it doesn't matter what the closing statement date is on a loan. It's not that critical. Credit cards, on the other hand, will make or break your credit. So we want to know what the due dates are on either one, loans or credit cards, but the statement closing date is not as crucial for loans as it is with lines of credit, credit cards, PLOCs, HELOCs, or business lines of credit. So those are going to be very crucial later on once you start paying off your debt, and then you revert or roll over from paying off debt to now using your velocity banking debt tool as a means of living your normal life, paying your normal bills, and then when is the best opportunity to make a payment and to keep your balance below the magic 9% to 0% range at the billing cycle or the closing statement dates, so that'll boost your credit score dramatically. Okay, identify your velocity banking debt tool. All right, so I've mentioned this before. And for my bank, and depending on your bank, and you can probably shop around, it doesn't harm you to actually look around and try to find a bank and ask questions. Look for the local credit unions. Look for banks that will say, if you sign up for a checking account and you qualify for the XYB bank, right? They have a credit card and they have a checking account, and you can say, hey, if I get the credit card with your bank and I open up a checking account with your bank, am I able to link my credit card to my checking account? And if they say yes, then the next question should be, what is the interest that you guys charge, and how is it charged? What are the fees? Are there any fees? Can I use it as overdraft protection? So you start asking all these questions. Or you want to know, hey, if I can, I'm going to transfer all my funds to this bank right here, because I can now use this velocity banking tool to the max of my benefits, right? I can pay my mortgage, I can pay my car payment, I can pay every single bill with a credit card at that point. So, and then I'll explain that in other videos. You guys can check those out as well. All right. You might want to look at your bank's personal line of credit. Do they have one? Right? You also want to know, let's see here, we're on number 6. It might be a credit card that you already have. So we're looking at debt tools. So with identifying your debt tool, it might be a credit card that you already have in your possession, right? It may be your bank's personal line of credit or your bank's credit card, like I mentioned before. But it also might be a new credit card that you can link to your checking account. That's what I mentioned before, is if your bank allows you to link your credit card to your checking account as an overdraft protection, and the fees are 0, no fees, no transfer fees, but no way around it. You're still going to be charged interest. Interest will start accruing daily compound interest. So that's fine. It doesn't matter, because you're going to throw in 100% of your paycheck. If you can link a credit card, you can throw 100% of your paycheck into your credit card, and that will satisfy their minimum payment, and it will keep your balance lower, and then your average daily balance and your average interest will be a lot lower. because of the way that you would do velocity banking. All right. And as I stated on that is my personal favorite choice, right? Is linking a credit card to your checking account. That's the best debt tool. Doesn't matter what the interest rate. It really doesn't matter what the interest rate is. But you can either choose to attack that card 100% and get it down to 0, or maybe you start with 0 and you just use the 66% rule. All right, so creating a weekly budget tracker. This is very crucial, and I think to me this is what I do. Keeping track of your budget on a weekly basis is life or death for the velocity banking, and it's also life and death for your credit card that you're using as a debt tool. Because if you don't project out at least a month to 2 months out on your budget, and then you'll say, hey, I'm going to use only 66% of my credit card and keep the remaining balance available. So for any overages that may happen, or maybe I chunk a little bit too much on a credit card, I want to make sure that I stay within that 66%. So I'd say anywhere between 50% and 70% is more of a cushiony area right there. Is having that amount of money is what I would use to chunk at a debt, right? So to calculate your 60% or 66% or 2/3 rule to your debt tool, it would be like, for example, say you have a $10,000 credit card. That's your maximum limit. You owe nothing on it, and you calculate 66% of $10,000 is $6,600. I know there's a whole bunch more sixes in there. I don't like including all those numbers. It's kind of bad juju for me. At least that's how I feel, how I think, right? If there is a balance on the debt tool, consider paying it off to 0. Maybe you want to go and chunk that down all the way to 0, and then use that as your debt chunking tool, right? So let's identify our debt tool, and then we're going to chunk at that card until it's down to 0, and then use that debt tool to start paying off debts, paying off expenses. All right. So we're going to identify the payment that will need to be made, and when will it need to be made, right? So what date does our payment need to be made by for our debt tool? All right. In which case we'll need to know what payments will be hit by our debt tool, right? Like cash payments, checking, auto withdrawal from your account. Let me reread this. Identify the payments that will be paid by your debt tool and which will be paid by by cash, checking, or auto withdrawal from your checking account, right? ACH payments like your mortgage, your rent, your car payment, things like that would require them to receive cash only payments, or do an ACH withdrawal, or writing a check, right? So now we're going to get into creating the budget line, right? So at the very beginning, we put the amount that we have, our balance that's on our debt tool, on the top line. We're going to write this out, right? On the top line of our budget tracker, we're going to put the debt tool, right? And then we're going to state how much money we owe on that debt tool. That's the very first line that you fill in, okay? Now, if you get paid once a week or once a month or every other week, then that's going to be your second line, but we'll get to that in a second. So if you can identify all your debts, right? Everything that you have that comes out on a regular basis, like your cell phone bill, your subscriptions, your gas, your groceries, and they're all averages for some of this stuff. But your cell phone bill is pretty much the same every single month, unless you're doing long distance calls and stuff like that. Your water bill should be pretty much an average. It just depends on how often you're flushing the toilet or taking showers or just running the sink forever and ever to wash your hair or whatever it is that you do. You kind of need to average that out. All right, so you're going to add your payment into your debt tool. So what I mean by this is your very first line was your debt tool balance. So your debt tool was $10,000. Let's say you had $10,000 on your debt tool balance right now. You threw in your paycheck. That's line 2. You threw in your paycheck. So now you subtract your paycheck from the $10,000 and you have a subtotal. So from your subtotal, right, Now you're going to have your withdrawals. Okay, so the withdrawals should be on line 3. So line 3, you're going to start with your date ranges. On line 3, you're going to state what is that week's date ranges, going from Monday, your first date, ending on Sunday, right? Write those dates that fall within that week. So if it starts on the 3rd on a Monday and goes all the way to the 7th, which is a Sunday, or whatever the date would be, I think it's the 9th. So if it goes from the 3rd to the 9th, then you have your budget dates that you need to pay attention to, and now you can calculate, because you already know what your average is, you know what your due dates are. You say, okay, on this date my rent goes through, on this date my car payment goes through, then this date I'm gonna split up my groceries and gas evenly throughout the month, and I'm gonna put $50 for gas on this week, I'm gonna put $50 for groceries on this week, you know, things that are kind of average throughout the month, and you just write that in your budget and say, okay, this is what I expect to see come out of my paycheck this week. Okay, and you're going to write down on that 3rd line withdrawals. The word withdrawal goes on the 3rd line. Okay, so I know that I wrote in here, input the word income after the week dates, but that would technically be on the 2nd line. Okay, so that's not actually the 3rd line. And I'll give you examples. You can check out my videos on how this is done. All right, so on that 2nd line, right, on that 2nd line, you're going to write income, and you're going to put whether or not you get paid within those date ranges that we talked about earlier, right, on that 2nd line. So not 3rd line, 2nd line. So the 2nd line is your date range, and then the next area next on that same line is income, and then whether or not you get paid within that date range. Say it's on Friday, then you write down the amount of money you expect to receive that Friday. And if it's an average, it's just an average. It doesn't have to be accurate, because we understand if you get paid hourly, sometimes it goes up, sometimes it goes down, but we just write down the average. Okay, now the technical 3rd line should be your subtotals. All right, the subtotal is on line 3, right? I have that written right on line G, right? Subtotal for your amount remaining on the card is on line 3. So you should be able to see the balance on your card decrease because you have added your income into there. All right, now the 4th line is going to be withdrawals. Withdrawals is all those payments I mentioned before, anything that occurs within that week, and then also your averages for gas and groceries, because that fluctuates throughout the month. Okay, now you're also going to account below that anything that has to do with interest, right? So this is where that closing date is kind of crucial. So if you have a closing date that is on that week, then you're going to go ahead and calculate the interest for that week. Now, if it doesn't happen during that week, just put a 0. So an example of calculating interest for that week, let's say we started the month, the very first week, with $10,000. So that we want to start with the highest balance of that month. So we're going to go $10,000 times 20%, which is 0.2, divided by 12, and that gives you $166.67. You need to add that into your line, your 5th line. Okay. Then on your 6th line, you're just going to go ahead and do the simple math. You're going to add everything up. So you had your subtotal, whatever that number is, and then you're going to add in your withdrawals and add in your interest rate. So it's going to give you a large number at the end of that week on line 6. And all you gotta do is simply just repeat that cycle for the next week, for the next week, for the next week. All right. So we're gonna cover the notes here. What happens if you run into the beginning of the month where, say, the 1st is not on a Monday, or the 1st is like on a Thursday or something like that? So let's just do this one. So let's just assume that, and not so much assume, let's go ahead and follow this rule. So the rule I put is if the week that I'm looking at has at least 4 days that covers the month that I'm writing my budget for, then I will include the prior month's days into my budget. So if I have less, then that week doesn't count for this month. So What I mean is, say that the first of the month is on a Wednesday. So you have Wednesday, Thursday, Friday, Saturday, and Sunday. That's 5 days, right? So 5 days out of 7, right? There's 7 in every single one of our weeks, 7 days total. You have 2 days, right? Those 2 days would happen to fall on like the 30th or the 29th. That would be included in my week for this month's budget. So I'd include 29 through the 5th, and that would cover everything that I need from Monday to Sunday. All right. If you were looking at the end of the month, for example, and you have 4 days that fall within the last week and 3 days that follow from the following month, then you need to start from Monday and then count through Sunday. And it would be like, let's say the end of the month happened to fall on a, let's see here. How did I write this out? I say, for example, say that the last week falls on Monday, all right? The last week falls on a Monday, and the 27th goes through the following month to Sunday the 3rd. Then you would account for the 27th, 28th, 29th, and 30th, right? That's 4. That follows the 4, the days of 4, and then the 1st, 2nd, and 3rd gives me 7. Right? That's 7 total days in my budget. So that part of that first part of that next month would fall into my last week budget of that month, right? I don't know if that makes sense, but you can always refer to my videos on what I'm talking about, how I calculate my months. All right. All you need to do is rinse and repeat all through your budget until the credit card falls below 66% rule. Or if your goal was to start a zero interest owed on your debt tool, then you can identify the next debt that you want to start chunking at. So let's say we focused on this one debt tool, we get it down to 0. Now we do the 66% rule and say, okay, I want to throw $6,600 at this debt, the next debt. And then you would do that, pay it back down to 0, and then do it again, do another chunking, and then pay it down to 0, and then do another chunking, and keep doing that over and over again until all your debts disappear. All of them are paid off. Okay? So for example, say your debt tool, you owe $0. You can now chunk 66% to your targeted debt. Just focus on one debt at a time. Don't disperse your chunking amongst a whole bunch of debts. Just focus on the most critical debt that you need to pay off now. Or you're doing the snowball method, or you're doing the avalanche method. So the snowball method in this case would be like, oh, the lowest hanging fruit. I'm just going to pay off this super small credit card. Or if it's the avalanche method, maybe you want to go for the highest interest or the highest payment, and then work your way down. So whichever method you want to use in that manner, that's what you're gonna pick. Maybe it's something that's coming due, and you had deferred interest for a long time. You're like, oh crap, I need to start slamming payments on this Best Buy card because they're about to charge me 40% interest on this big screen TV, and it's been accumulating for the last 24 months. So I better start making payments. I'm just saying hypothetically, right? So do remember to continue to pay your bills the entire time that you're doing the velocity banking. Pay them on time. Never miss a payment, because those fees and everything else that they're going to tack onto you and the hits to your credit are going to be crucial. You want to make sure that you stay on time. You at least pay the minimum, right? Never pay less than the minimum. Always make the minimum, and then you should be good to go. So if you have any questions, any comments, any concerns, please post them below. Let me know where I made mistakes. I see a lot of typos in my stuff, but that's okay. We're all human. I'm not a machine. And I do this. I do it all the time now. And I'm been working velocity banking, and I'm fairly new to the velocity banking thing, but I pick up numbers really quick. So I'm not a financial advisor, and I just do this for fun, and I like to help people get out of debt. I've helped my spouse. I'm helping my parents. I'm helping my friends. I'm helping out anyone and everyone that needs to know how to do this velocity banking so that they too can see financial freedom and to build their wealth outside of debt, so they can actually start saving money instead of losing money. because you don't want to be putting money into a savings account where you're just losing money all the time. Okay, so we'll get off my soapbox for now. So please do like, comment, and subscribe. And until next time, guys, please stay smart with your money and stay safe out there. I'll talk to you guys later. Bye.